Good afternoon, and welcome to the latest of our series of webinars. This one is on the clean fuel regulation and affordability, setting the record straight. A few housekeeping matters right off the top. If you have questions, feel free to put them in the Q&A section of the chat. We'll do our best to address them. I'll pause at a key juncture in the presentation, depending on how our timing is going. But the webinar will be recorded and available on our website. Just off the top, a pretty standard notice regarding compliance with the Competition Act and specifically anti-competitive practices that we ask our members and all attendees to webinars to observe. My name is Ian Thomson. I'm the past president of Advanced Biofuels Canada. We are a national trade association headquartered in Vancouver, staff of 10 people. I'll talk a little bit about the association in a minute. It's kind of right off the top. When I was in a commercial firm, I headed a team that imported and sold tank cars of biodiesel to racks coast to coast across the country for about 6 years. But it was in a period with far fewer legs in the pricing model, and regulatory compliance was much simpler. I'm going to be describing a number of approaches to costing and aspects of costing models, but this is an area where it is generally prudent to describe any outcome of an assessment as indicative of what happens in the markets. Some aspects I won't touch on, such as risk management and procurement, spot versus fixed pricing strips, or the impact of non-commercial trades in credit markets as examples. So the reason we're holding this webinar is to raise awareness of costing of low-carbon fuels and biofuels specifically, and you'll see in the data that I have later why they are really the predominant low-carbon fuels that are driving market pricing. And I want to address the complexities that we have to consider. Also to address specific pricing estimates, such as those by the PBO, which we've critiqued in past. ABFC maintains a capacity to assess costs in order to inform policy and understand the factors that support or impede the uptake of biofuels and all clean fuels. We do not provide any guidance or information to members on pricing, and nothing that we'll look at today will get into proprietary or confidential pricing matters. I'll start with bookend with the key messages that we're going to come out of this. And off the top, accurately projecting regulation costs is complex. Non-market entities make significant errors. And we've corrected on numerous occasions methodological errors in reports by entities that have no experience in fuel markets. Most assessments do not reflect octane value, for instance, or demand elasticity with respect to refined products. Clean and low carbon fuel markets are not a tax. And if you want a really succinct and street level description of why not, the Canada West Foundation did a report on the CFR some years ago, and you can simply Google Canada West Foundation CFR, and you can read that. It's a great pizza analogy. Economics of biofuels have become critical to key Canadian sectors and need to be part of the equation about the overall impact on the Canadian economy. That is more true now than it has ever been with trade challenges, etc. And I'll lastly say that the PBO office assessment is frequently misquoted and misinterpreted, and people haven't read the fine print, and it's also simply inaccurate. We're going to get into that. Just off the top, our members are 35 and plus or minus in number. They're active in every aspect of the biofuel and clean fuel value chain, from feedstock providers and processors to biofuel producers, to refiners and fuel marketers, as well as market intelligent firms. I've tapped our quant team for this presentation. I want to particularly thank Ryan Foxall, our clean fuel research associate, and who was an employee of the BC Low Carbon Fuel Branch for a number of years. So he has critical knowledge. And also want to thank Farah Shaki for all her coordination work and in the background here. I'd also be remiss in not thanking a small number of our Canadian and U.S. Producer and trader colleagues with global scope who keep us abreast of changes in the factors that apply fuel and pricing. You know who you are. Thank you very much. Members have basically no tech clean fuel or low carbon that our members don't touch. And so we've got a fairly good understanding of how some of these products and co-products will impact pricing. I'll just note that some of the analytics that I go to today come from our members only section of the website, where we have good data on market data and also credit market data. But we also have a fair number of these resources available on an uplift basis in the Biofuels in Canada Plus report, and a lot of these are found on our website. If you need help locating those, please contact Farah afterward. I'm just going to touch on an overview of what Canada has by way of markets. It's important. If you are in the US, you will appreciate that the Canadian market varies from that market in a number of points, but the most significant is that subnational fuel regulations, i.e. provincial regulations in Canada, cover 95% of all motive fuels, whereas in the U.S., this is limited to states like California, Minnesota, soon to be New Mexico, Hawaii, et cetera, that have clean or renewable fuel standards. Canada's range of fuel regulations go from pure low carbon fuel standards like that in British Columbia, and the federal clean fuel regulation, and it covers all provinces. We also have what I would describe as LCFS light regulations in Ontario and Quebec that have carbon intensity thresholds, but they're largely static and only partially motivate lower carbon intensity in fuels. Alberta, Saskatchewan, Manitoba have traditional renewable fuel standards with no carbon intensity scoring, excepting in Alberta where there's a minimum eligibility threshold. What this does in the context of today's discussion is create considerably different dynamics across the country. For instance, in British Columbia, it's very stringent regulation, which, by the way, covers jet fuel, which no others do. It attracts considerable biofuel blending, not only to meet the BC standard, but also to generate compliance for obligated parties with the national presence. So you will see biofuel blending in British Columbia that goes well above what would be required, and it's just easier for people to adopt all of their liters there. And this is just a leave behind if you want a bit of a snapshot of assets in the biofuel production, feedstock production, and refined product locations across the country. So let's kind of dive a little bit here into some of the complexity. And again, I'm going to put out the caveat that this is going to be a bit of a bus tour through Europe, if you will. We're going to touch down on a whole lot of topics that impact pricing. I would be surprised if you walked away from this webinar and said, okay, I know what exactly the pricing methodology is for biofuels. Again, back to the intent, it's really to sensitize it and to share the different legs and how they impact, and put a flag on some places not to go when assessing prices. So off the top, so CFR and British Columbia certainly, and Ontario, Quebec to an extent, are what you would call market-based regulations. They have credit markets and they have carbon intensity scoring, and that adds the complexity of multiple legs. Costs reflect regulatory design in both the end-use market and in the supply market. So things like stringency, more stringent regulation will generally be more expensive because carbon intensity and reducing it in alternative fuels costs money. In the supply market, and I'll touch on this a bit later, you also have significant impacts. So For instance, the U.S. Advanced Biofuel Renewable Volume Obligation of the RVO, currently in play, has had a significant impact on the supply of biomass-based diesel for the North American markets, having a global, in fact, impact. The small refinery exemptions are another one that are kind of live, and those will have an impact on Canadian markets, and et cetera, et cetera. Canadian biofuel costs and savings vary by the type of biofuel, and I'll cover that later, whether it's a biomass-based diesel or an ethanol. The season. Some seasons are easier to blend in for biodiesel than others. Renewable diesel more year-round. For instance, ethanol unimpacted by season, largely. Logistics. Some regions are harder to move product to if it's not in a pipeline, and biofuel in Canada is not, for the most part, pipelined. And then the region. Whether depending on what kind of fuel orbit you're in, whether you're in the Western or the Central Eastern Canadian one. Another factor is when and where obligated parties pass CFR and other costs to end users. It's opaque, and it's just simply not, you can't kind of point at a province and say all of the fuel supplied there are reflected in the cost there, because that's not necessarily how it works. In the U.S. market, the CFR and all provincial markets rely to varying degrees on U.S. imports. It's generally significant. Given that, and this is a really critical part of understanding costs in the Canadian market, if you are a Canadian buyer, you need to somewhat match U.S. pricing, and you need to bid that product away from the U.S. market. If the market is tight, and I'll get into tight long shortly. But RINs in the RINs, the renewable identification number, is the instrument that an obligated party will use to demonstrate compliance with the US RFS, and the California low carbon fuel markets have a really significant impact, particularly on biomass-based diesel. In an unbalanced market, whether it's long or short, it creates different pressures and opportunities for the Canadian market. So this is the key idea of buyer and seller power. And this is often ignored. And unless you are dealing with parties that are participating in the market on a day-to-day basis, you'll miss this. So factors that move the market balance, higher stringency markets with biofuels with lower CI are more needed than in less stringent markets. And when you lower the carbon intensity of a biofuel production platform, whether it's using carbon capture and storage and ethanol, or using alternative energy sources or low CI hydrogen and renewable diesel, as an example, those all have an impact. You have physical supply, and I've covered some of the seasonality and logistics. You've got the impact of the U.S. market right now. Well, let's get to some examples I think might lend this. So you also have to look at who you are looking at. We have two sets of broad parties in markets. You have obligated parties who are generally refiners or importers of conventional fuels, and they must acquire credits to meet regulatory compliance. So their goals are to balance least cost options, but they also have costs if they don't comply. So you might see overcompliance, you might see reliance on a more expensive option because it has fewer fulfillment risks, or will not leave you high and dry if there are logistical hiccups. Obligated parties, and we'll touch on this later, largely blend or self-generate their own credits. These tend to be more reliable for them. They can utilize existing assets, and that can be a lower cost option. They will buy credits if it's material cheaper than physically blending, and that's based on the fuel type, the logistics. There are some places where it's simply easier to rely on a third party to do the credit generation work for them. Discretionary parties are have long been a factor in the U.S. market, and really under the CFR, we've seen a real tranche of discretionary parties come in, whether they are global biofuel traders and brokers, down to Canadian companies that are providing fuels outside the standard system. They might be using different distribution assets to do it. And so they they participate mostly in the biomass-based diesel market because gasoline almost wholly flows through the retail network in Canada, and that's just got a different set of ownership and control dynamics. But biomass-based diesel, providers of renewable diesel and biodiesel have access to large fleets or sinks or mines or marine fleets or et cetera, rail. And so if biomass-based diesel is at parity, that's a signal for arbitrage, and a discretionary party can go in and make money and either provide biomass-based diesel at parity or at a discount to diesel, and any end user that wants simply the green credentials but pays the same as diesel will be happy to take that deal. And an entity that doesn't really care about the green aspect of it, but simply wants cheaper fuel, can also at times get that too. Discretionary parties enter and exit the market purely based on economics, and their credits can be more or less expensive to generate than obligated parties, and that explains some of the flow. Part of the challenge of assessing markets is there are data that are visible and available to all people if they know where to look. So kind of the visible and the not visible or invisible data. Published credit prices are widely available. Environment Canada published the CFR. I've referred to British Columbia's publication of their credit market. I'm not saying that those credit scoring reports are necessarily indicative of what the market is happening in the moment. There are legacies, et cetera, to credits, and those will have a bearing on whether they're reflective of the current status or not. You have reported CI scores. British Columbia, very detailed in its CI reporting. ECCC, for confidentiality reasons, reports really only on aggregated of different fuel types. Commodity prices, CBOT, NYMEX are all widely available. We tend to have fewer Canadian reporting agencies, but you can do subscription and get Opus, Argus, et cetera, will report on Canadian values. And then regulatory requirements obviously are available to anybody. If not simple, they're at least available. Data that are harder to see, people who trade who are in the trade in biofuels will have access to data intraday, like on an hour-to-hour basis or day-to-day. And unless you are talking with those people or subscribing to price reporting agency daily reporting, and our association does, and many others do, you're not going to see those data. Same and related party transactions are opaque, and those have a bearing on credit prices. Contract pricing and logistics are only known to the party and the counterparty. Refining margins and how fossil fuels at wholesale are priced on a rack-by-rack basis are opaque and not necessarily reflect the cost of putting product into that market. If you're a national entity and you have more competitive markets in one region than another, you can move your financial equation around. Compliance strategies. Every entity is going to have its own compliance strategy. Some obligated parties will build large, very expensive biofuel production assets, and others will rely wholly on purchasing biofuel and the credits associated with it from a third party, a biofuel producer, a trader, or broker, and then pass through. The long debate in the biofuel world about whether end users will see the cost of regulation or whether the refiners will absorb it. It is our view that those are costs that will be passed on, like any cost that hits refined market products. Important data they're opaque, they're expensive, they're absent, they're out of date. And so this explains why some assessments simply don't touch that. Our US colleagues are accustomed to timely data. We don't have that, as I've explained before, and that's kind of what we're working with. These are two broad approaches to assessing biofuel markets, and I put an asterisk against broad. This is not a formula. These are general approaches, and there's some crossover between them. But on the left, in a market that is not carbon intensity based and may have renewability requirements, it tends to be a simpler market to assess. And there you have you can go to the physical product, whether it's Kinder Morgan's Argo in Chicago for CBOT pricing, or whether you go to or CME ICE, and ICE provide those, or whether you go to New York Harbor pricing available from NYMEX and you use those as your basis. And then on the basis, you add on things like transportation costs and foreign exchange, and you have to convert units, et cetera. Barge, rail, demurrage, all of those factors impact. And you can kind of on a bottom-up basis construct using data available to say what the cost will be, and probably reasonably reliable. If you are, on the other hand, in a more market-based, pure market-based mechanisms like the LCFS or the CFR or the California LCFS, an example, it's really credit prices and carbon intensity scoring that will determine what kind of economics the biofuel seller can enjoy and what kind the market has to suck up, if you will. The California LCFS, and this is particularly the case for biomass-based diesel, it sets marginal conditions. And California is such a huge economy and a huge market. Its market in gasoline exceeds Canada. In diesel, it's more equal. So we're talking about a Canada-sized fuel market. It's significant. Oregon, Washington, and coming along New Mexico and Hawaii will also have a bearing on the Canadian market by the demand of their product. When markets are tight, and they are right now on biomass-based diesel, on the diesel market and distillates in general, because of conflict, global conflict, actually Middle East conflict specifically, cause Canadian buyers to have to bid away, and they have to bid it away from the LCFS market. And I'm going to get into some of the factors that address how much you have to bid away. You are much more reliant in assessing these marks on trade intelligence from price reporting agencies or from firms that are participants and actors in the actual trade, whether it be traders or brokers or biofuel sellers, if they deal directly with the end market. So those are two broad approaches, and let's get a little bit more into them. So there are multiple legs, but here are four key legs in the pricing model. And I described earlier that a renewable fuel standard is much easier to price than a low carbon fuel standard. So the CFR or the LCFS or the California LCFS credit price is a critical piece of data. What is also critical and not visible is what we call the capture rate. What I mean by that is that in well, I'm going to save this for, I think, the next slide because it aptly describes it. Yeah, so different markets. So a capture rate essentially means that you're only going to be able to claim the carbon intensity up to a certain point. So what I mean by that is if the gasoline baseline in the low carbon fuel standard in British Columbia is 74.8 grams. I believe that's the 2026 threshold. And if ethanol can be procured for 30 grams, then you will see, notionally, you would think I'm going to get all of the value from 78 grams down to 30, because that's what generates credits. Ethanol, however, is a long product. There's a lot floating around, and there's actually a fair bit of low carbon product floating around, specifically available to the West Coast markets. And a little kind of tiny market detail, the ethanol plants in the US that are on the rail lines that ship to California, Oregon, Washington, and British Columbia tend to be those plants that have done things like carbon capture and storage, or biogas for their thermal generation, et cetera. So there's a fair bit of good low carbon intensity ethanol floating around, and it's a buyer's market. So you may want to get the carbon intensity for everything that is above your product all the way up to the baseline. You're not going to get it. The buyers will say, we'll give you the carbon intensity using the market pricing for everything from 30 grams down, whatever the threshold that they may set. I think in British Columbia is right now kind of 38, 40 grams would be what the market wants to see. Biomass-based diesel, a different situation. The RIN price. The renewable identification number, a RIN has to be retired at the border if it's exported out of Canada, out of the US. However, a US seller will get that RIN. It's worth a lot right now. And RINs respond to market prices and to feedstock prices and to refined product prices. It's one of the moderators. RINs are the balancing mechanism in the US market. So to bid away product in the biomass-based diesel in the US, from the US, you have to essentially pay all of the equivalent of a RIN, even though the RIN had to be physically retired, because at the margin, a US seller would rather sell it in the market. They'll realize the RIN, they don't realize it in Canada. So Canadians have to kind of suck it up and pay the RIN. Ethanol is completely different. Ethanol doesn't really get any capture on RINs because it's a long market. There's a fair bit of product floating around, et cetera. And so very different dynamics. Here's an example. So for ethanol in Ontario and Quebec, it's a balanced market, or a long market. It's well supplied. There's no real visibility on Ontario and Quebec CI scoring, so it's harder for a biofuel producer to expect to see value given for that. There's no CI value above, the buyer set thresholds. There's no RIN capture. And then the dynamic in those provinces is that, in fact, across the country largely, is that ethanol on a per liter basis is below conventional gasoline at the rack. So it's actually physically a cheaper product. And we're going to talk about what that means. Renewable diesel in British Columbia, a very different situation on the other end of the scale. It's a very tight or short market. It's a tight domestic market. Made in Canada requirements in British Columbia and Ontario are likely exacerbating that tightness. Monthly credit prices apply to CI values only below the threshold, and I described that on the previous slide. So, however, because it's tight, you're likely to be able to command a full RIN and a full BC or California LCFS price, and that's just the way the market happens. I really should say on things like ethanol, and if it does happen, biodiesel sometimes is a less tight market than renewable diesel for various reasons. You do have some carbon intensity giveaway, and so you are getting carbon intensity essentially for free. This is an example of the model that we run internally, and my colleague Ryan Foxall, with assist from our other quant team colleagues, can maintain this, and we can run this for ethanol, we can run this for biodiesel, we can run it for renewable diesel, and we can get a sense on what the cost the market what the market is needs to deliver to pay the index prices. So this one's for ethanol, and because there's no RIN path through and there's no CI valuation, it's a zero cost. Ethanol is actually on a net basis, a negative compliance cost, and we'll talk about that. If I run this for renewable diesel, I'm going to get a higher cost. If I run it for biodiesel, I'm going to get a higher cost. And so then you can put these three together and you can get an example of what a blended cost might be. Here's another approach that people have seen to assessing the net impact of a regulation. It's called a MACC, a marginal abatement cost curve, if you will. And what this essentially recognizes is that you, to meet the requirements of a regulation, you require a certain volume or carbon intensity reduction capacity of all of the different alternative fuels. This one was something that we co-developed with British Columbia in 2022. So this is out of date. I'm using it as an indicative or illustrative MAC. But you can see that some compliance options are negative cost of compliance, which means there's a savings on them. But look, in the case of LNG and CNG, very limited. And part of that is because while they may generate credits, their carbon intensity is close enough to the fossil baseline, whether it be gasoline or it's going to be largely diesel because it's LNG into distillates. It's got limited impact. Ethanol is also a negative compliance tool. There's a lot of volume. It is a higher carbon intensity option generally than biomass-based diesels. So it will have deliver a fair number of the credits. And then you get into biodiesel, renewable diesel, HDRD, and renewable, and then you've got co-processed fuels. And those are an emerging option that are quite prevalent in British Columbia and have some uptake in the CFR. So you can average this out and say the average weighted, the price times the volume of credits that they deliver, and you can get essentially a blended compliance cost. And we would say that this is a reasonably decent way to look at an overall compliance cost of a regulation. However, it doesn't get you past the need to be able to assign the dollar per ton of compliance cost for each of those options. One last aspect before I get into, I believe, addressing the PBO, and this does not hit in any quantitative assessments unless you're a pure, economist. But there's no better time right than today to look at this dynamic. So, restricted crude oil supplies have driven gasoline pump prices higher. They've driven diesel prices even higher, and market observers will say that this is actually more a function of global refined product capacity and challenges than it is necessarily of crude supplies. But the basic concept here is that when you have less supply and when you have a tight market and you add supply to that tight market, you reduce prices. This is just as old as economics 101 can get. When you have lots of supply and you insert more into the market, it's not really going to impact prices because the market is well supplied. So we have a number of studies that I'm using here to illustrate from across the years that essentially show that impact. This is not reflected at all in pricing, but it's very real. And when you talk about on the left, this is a headline, by the way, from yesterday. U.S. diesel supplies hit record lows. So what happens when you dump a whole lot of renewable diesel that is not compromising refining capacity, or biodiesel that is not compromising refining capacity? They're bolted onto the side of it. You get lower prices. We don't reflect that in any of the and the pricing models. I'm going to stop for 1 second to see if there are any questions in here that I need to address. I'm not seeing any right now. Farah can alert me to to them if there are questions that do come up, and I'll certainly pause at the end. Let me see. It looks like maybe some questions in here. I'm not seeing anything. Okay, let's touch on the PBO report. And quite frankly, this was kind of got us going on this a couple of months ago to say we need to get back out with data on what this report does and what it doesn't do. In 2022, the PBO did an assessment of the CFR, and they called it a distributional analysis of the clean fuel regulations. And there was a whole lot of media around it at the time, and different headlines, et cetera. And the report continues to come up. So I'm going to address what is flawed with that report. In fairness to the PBO, they took Environment Climate Change Canada data published in the RIAS, and in Table 23 in the CFRs, Canada gives that to RIAS. It showed a range of costs tied to a compliance strategy, and the three compliance strategies, and they just bracketed them at all, nothing, middle. The first one was 100% self-created. This is obligated to do all of their own fuel blending, and they don't buy any credits. The middle is they generate 50% of the credits and they buy 50% of the credits off the market. And then the last option is that they generate none of their own credits, they buy them off the market entirely. ABFC at the time wanted to demonstrate that even with the most strict or unlikely market behavior, the CFR still returned a positive value on a net basis. And we appreciate that intent. However, what observers have taken is that and the PBO took the price that they published and said that is going to be the number. So the problems with that approach, anybody who's in the market knows right away the problems of that approach. The only way that you could have somebody purchase 100% of the credits of their compliance off the market, and this is what the PBO modeled with some caveats or some cautions, would be, for instance, to have every single gas station in the country blend ethanol that they procured somehow on their own, even though they're owned by a refiner or they're under a refiner brand, and that's significant. The majority of stations in the country are under one of those two models. It's an impossible outcome. You simply couldn't achieve it. And I will note that the BC 10-year reliance on the credit market is 24% on average. In 2025, it was 39%. 2025, by the way, was an exceptional year, particularly in biomass-based diesel markets, for two reasons. One is the US RVO numbers were under debate, and it was unclear where the RVO numbers would go. But the bigger impact there was the US Treasury had yet to publish the final binding and reliable guidance on the value of the 45Z Title 45Z clean fuel production credits. Those are the ones that are exportable to Canada. And so in the absence of that, the biomass-based diesel market for a number of months kind of shut down. Producers stopped buying feedstocks because they had no idea what kind of carbon intensity rules they were going to face. Product into Canada flowed very slowly, and you don't just turn the switch back on when you've got rail cars that come from thousands of kilometers away. It takes months to get the supply started again, kind of like you don't just turn a refinery on after a shutdown. It takes a while to get it back up, even from a soft shut. So 2025 was an anomalous year. Whether you'll see 20, 39, or 40% of purchase off the market is unclear going forward, but the result in 2025 was a significant drawdown of obligated parties' credit banks and significant purchases from third parties because obligated parties needed those to stay in compliance. So this is a thought exercise. If you wanted to take the PBO's report or the ECCC Table was it table 39, table 23, whatever that table was. And let's extrapolate it and go on the low end to 100% self-generated credits, and on the right hand end, 100% credit market purchases. And you can see the cost there on the right hand end of those two lines. The two lines to the left are the BC averages, 15% up to 2021. 24% up to 2025, and then in 2025%, it's itself that single year is 39%, and you can see it delivers a very different set of numbers than the 16 and 17 cents that are widely cited. And I'm not saying that the numbers that are on this chart are the costs, but I'm using ECCC and PBO's own data to show that even their own data don't support their own conclusions. In fairness to the PBO, and I don't think, look back to this slide here. The PBO did say that the ECCC estimates of the economic impacts used in the analysis are based on the upper bound price scenario presented in the regulatory statement, which is the CG2 RIAs. And then in a footnote, a more likely scenario would result in some credits sold, et cetera, et cetera. Now, a number of entities have not read the footnote, and they're reporting and said it will, and it's simply untrue. And the ECCC and PBO reports actually don't support that conclusion. So what is that? Let's contrast this with what actually happened in the low carbon intensity fuel market, biofuels. So this is the CFR credit generation reports. These are on our website. I believe these are on the member only section, but here are the data. So carbon compliance category 2, which is low carbon intensity fuels, aka biofuels, on the left, and you can see there the range is in the millions of credits generated by those fuel types. Over on the right is CC3, which is renewable natural gas, hydrogen, battery electric vehicle charging, etc. We only have data, ECCC has only provided data for 2022 and 2023 on credit generation on CC3 that we're aware of. So the picture that this paints, and by the way, I'll say on CC2, we have a number of significant biofuel producing facilities that have come online since then, some of them having a significant impact on the market, and some more of an emerging ones. Those would include Imperial Oil's renewable diesel plant, the Brea renewable diesel plant in Newfoundland, VerBio coming back online in Ontario, and all of those have a significant portion, a huge portion of the Canadian biomass-based diesel plant. And anyway, that's another factor in there. So what we're looking at here, if you look at this, and you can see that CC2 compliance is 85% of the clients credits from June 22 to May 2025 came from biofuel blending. And ethanol, I'm going to use ethanol because it's a great case to make the case for the errors in the PBO report. So ethanol is responsible for 53% of those CC2 credits. So essentially, ethanol was responsible for plus or minus 45% of all credits generated for compliance in the CFR. So what does that mean? Well, let's go to kind of bottom up ethanol pricing. So CBOT, Canadian Chicago Board of Trade, ethanol currently trading at a 28.9% discount relative to NYMEX reformulated blend oxygenated biogasoline. This is the base gasoline for blending. It's a 31% discount. So ethanol at the rack in a big tank, wholesale, is 31% on a 5-year basis less expensive than gasoline. Some folks will say yes, but it has less carbon intensity, and the Navius Research takes into account all of the energy densities, et cetera, in their numbers. Navius Research, they have assessed, largely based on octane value, ethanol that has a negative compliance cost, i.e. it has a savings of $235 a ton. It's negative. The PBO, so this is where the disconnect, and ethanol is the perfect poster child for the disconnect between what the market's actually doing and what the PBO report and people who point to 17 cents a liter by 2030. They said it's going to be 17 cents a liter. How can a fuel pool that represents 45% of all of the CFR generation with a negative $235 per ton compliance cost add 17 cents to the cost of gasoline in Canada? It's impossible, which doesn't stop people from still continuing to cite it. Over on the right, from the Biofuels in Canada report, available at the Navius website, you can see the relative cost in the gasoline pool minus negative 35. Biomass-based diesel and the diesel pool, different matter. Tight market, a more expensive product, and that does have a cost. And we fully acknowledge that. So here are some of the data from, I believe, our Biofuels in Canada Plus report, which is on our website. These are updated on a month-to-month basis. And you can see here the 2024 data for diesel and gasoline. And on the net on the right-hand side, you can see that the CFR has a minus $275 million cost. These are indicative. The Navius report does not account for all the carbon intensity factors, which vary by region, et cetera. So indicative only, but we're certainly not seeing the costs that the PBO adds. Again, so just some more data from that on the total cost impact in the gasoline pool and the diesel pool. And every year varies because every year is different on commodity pricing and on crops, et cetera. Let's see, what are we saying here? Yeah, so in a press release that we put out several months ago, we shared some analyses that were new to us, and we pulled from Navius, but we pulled from a number of other places. We pulled from StatsFan, from USDA, et cetera. So kind of 4 data points is, the $112 billion for fuels that Canadians largely paid for fuel. Biofuel savings in gasoline were net 101.25 billion of costs. Every year, Canadians spend, and there are different categories, but their current household expenditure is $76,000. Diesel, if you don't want to take diesel alone, it would have added $52 a year to a household's cost. Gasoline, though, took that back, doubled. So there's a net very modest savings. It's indiscernible is the term I would use. And we, to come up with that figure, by the way, we applied the CFR's cost to every liter of gasoline and diesel sold in the country that would go into a truck, would go into a train, would go into, et cetera. And we said, households got to pick that up. Let's assume they have to pick up, but those numbers are based on that. So it's certainly conservative. Drill down against StatsCan data into what a household spends on food every year, $12,000, almost $13,000. Again, if you say the diesel pool from the trucks and the trains that use to move food from source to grocery store, and it all moves on diesel, to what goes into tractors to produce crops, all of that. It added 0.04% or 1/17% to a food budget. So when we see voices in Canada saying the clean fuel regulation is a hidden carbon tax by the government, and it's adding significantly to grocery bills, I just use a plain simple tool. That's rubbish. There's no basis for that. It's not a defensible claim. So why are we having the webinar? To take that kind of claim on. The USDA has a much more comprehensive assessment of what they call the food dollar. And they look at what an American will spend from a different number of different angles of the market. What comprises the different costs that make up the food dollar? And they said that about 3% of 4% of the data here, 4 cents of $1 are going into transportation, and transportation, that's all transportation costs, of which fuel is a part. So you can see here that fuel is a really minor component to what goes into costs. Okay, we're kind of coming right down to the end here. I did not pause, so I'll pause at the end for questions. But what are the key messages that come away? Accurately projecting costs is complex, and non-market assessors of costs make significant errors, which we've tried to describe today. Clean and low carbon fuel standards are not a tax. Economic benefits of biofuels have become critical to key Canadian sectors and need to be part of the equation. I think all Canadians would feel the impact right now if the canola sector did not have the really significant outlet of biofuels in its portfolio of markets when China shuts down, U.S. shuts down, and that's a massive impact on the Canadian market. It's in the multiple billions of dollars. We don't count that. But it's really a critical part of the of food security, frankly, and volatility in food production. The PBO report is frequently misquoted, i.e., people don't recognize that ECCC itself said upper bound is not what you should be focusing on. People have ignored that, and then just their calculation basis of 100% credit generation is impossible. And then again, most assessments don't reflect things like octane value and the demand elasticity of refined product, which I just covered. Net, there's no accurate real-time dollar per liter or cent per liter costs, and credit market costs do not equal regulation costs. And people in the market know that the credit price is the price that you pay for that marginal cost of compliance, because you do your own self-generation, as we've seen, and those are generally significantly less expensive than buying credits. So using the credit price, and when you combine it with the fact of capture rates, both for RINs and for credit prices and carbon intensities, you simply can't take a credit price and multiply it against the carbon intensity and come out with a cost. I am going to stop there and look to colleagues. Okay, so Farah, what are we dealing with? Do we have people with questions?
We have 3 questions in the Q&A section of
Great, I'll pull them up here. Okay, so I'll take these, I'll go back and try and go back to the first one 60 minutes ago. The last study mentioned BBB can lower the cost of diesel. Is that only during price shocks? No, that last report was cited over, I believe, 1998 to 2006. So it would covered a range of period. I'd have to go back. You can follow up with me on that particular study. I didn't put the links to them in, but I can make them all available. The links to them, by the way, are in the press release that we put out a couple of months ago on CFR costs. Next question. How much of the 2025 drawdown can be explained by pre-election uncertainty? Great question. Regarding the CFR's future delaying purchasing decisions. Absolutely. Thank you for reminding me. That was a really significant impact. It was known in January that there would be February, there would be an election. The election was in April, and absolutely, obligated parties held back because the opposition party, which until January and the imposition of tariffs had said they were going to kill the CFR. And if you're an obligated party, you absolutely need to balance your risks. And it was not unreasonable for obligated parties to hold. And so everything just went into a hold pattern. And when the election happened, reference my previous comment about it takes months to wind the logistics change back up, people were scrambling to cover their short positions on credits. And so they did drawdown, they did purchases off the credit market. We'll have to wait to see what the 2026 data show, but we certainly look at 2025 as an anomalous year. So that's the Canadian side factors that were going on in addition to the RVO and the 45Z factors that I described previously. So yeah, it's spot on. It had a material impact, and you can see, by the way, why policy uncertainty and political uncertainty has a huge impact on these markets. Last question is how does diesel biofuel impact the modeled food cost, greater on-farm fuel costs? It does. The USDA food dollar would record all that. We did a fair bit of work. My quant colleagues did a fair bit of work to try and go all the way down to farm level. That's a huge job for a university department, a bunch of grad students to do. So we did not go that far, which is why we took it right up to kind of high level of let's put all of the CFR costs across the entire community. But what we did find is our internal calc said 3%. Of transportation costs in food, and the U.S. said 4. So we took that as a proxy that Canadian food and U.S. food systems are not so materially different. In fact, they're hugely integrated. So that seemed to be a reasonable question. I'm going to see some new posts here. Stefan, is ABFC getting any traction in changing the perception of the cost of biofuel policy, especially as it relates to political parties? Yeah, I think we are. We have engaged with provincial and federal parties over time. I won't kind of disclose kind of detailed conversations, but we do want to sensitize. And it's understandable that people who do not live in biofuel or fuel markets all day long don't really know what questions they should be looking at and don't know what they don't know. Yeah, we are. We're working that angle, and I would say the biggest impact today is twofold. That description that I shared, the price elasticity when in a really tight market, you add a substitute fuel or a fuel that can be used in the same engines and fuel that you're producing, it's going to lower prices. That's uncontested, and the volumes are becoming significant. For instance, in California, 3/4 of all diesel in the state is low carbon fuel. In British Columbia, I don't have the latest data, but I think it was 32%. So 1 of 3 liters in British Columbia is a low carbon fuel that's not tapping into and not exposed to markets. One thing I did not put up, but you'll see in our press release that I've referred to a couple of months ago is that crop markets responded with far less volatility to the Iranian war. They went up slightly, whereas crude markets and refined products still went up sharply. So even the base production economics were much less impacted. So biofuels are a great thing to use in a time of conflict because all of the biofuels that we use in Canada and the US are largely generated from feedstocks produced here, canola, soy, corn, et cetera. So there's a fair bit of insulation there. Anyway, I go on. Any other questions? We will be two things. We will be sharing the recording of the webinar. And secondly, if you have any questions, please do follow up with myself or with Farah. We'd be happy to answer as we can. I'll kind of go right back to the beginning. Our intent was to provide information to help attendees understand the dynamics that go on in fuel markets, not necessarily to say, here's a model that you can use to accurately assess fuel markets, because we don't know how to do that. And we live it in every day. So with that, I hope it's been valuable and look forward to any follow-up questions. Have a great rest of the day. Thanks.